That 1.9% Cameron circled includes agency mortgage-backed securities, non-agency mortgage-backed securities. So it includes residential lending that gets packaged up into the securitized, what would you call it? Just supply chains, if you will. And then some other securities that don't count for much. And then you add those in residential and commercial real estate, and then what's what I call non-real estate loans. I'll get into that. But this is how the U.S. banks lend into or provide money to the private sector. So households and corporations, right, are the big ones here, or households and businesses. And so if you look at where the growth is coming, right, the banks are, first off, 1.9% is like where you would clock the balance sheet contribution of banks' balance sheet expansion into the private sector. 1.2% of it is coming from other loans. I'll get into what other loans means. But what I mean is there's, say, 1.2 percentage points of growth from other loans. That's out of 1.9 percentage points total. So it's what that's saying in the measurements, how to read these. 60% of credit expansion, right, bank balance sheet expansion to the private sector is going into this other loans category. All right. Now this is where I get into the footnotes, number 17 and 18. You can go down the Fed's H.8 report on the website, see what this means. Who are these loans to, right? It's loans to real estate investment trusts or REITs, insurance companies, holding co's or other depository institutions, finance companies, mortgage finance companies, factors, whatever those are. All right, that takes you're getting real niche there. Federally sponsored lending agencies, investment banks, bank trust departments, and other non-depository financial intermediaries. So it's basically like lump that all in. That's what we call with the you call it like scary described term that got put on this in the 2008 crisis of the shadow banking industry, right? And then you look at the other, and then there's another section of others. It's actually two line items they break it out into. In footnote 18, loans for purchasing or carrying securities. So that could be repo, right? Loans to finance agricultural production, loans to foreign governments and foreign banks, obligations of states and political subdivisions, loans to non-bank depository institutions, like definition of shadow banking there, unplanned overdrafts, that just could be a corporate account, right? Getting hit with an overdraft, pay $25 per, right? It adds up for people who do that. Loans not elsewhere classified, so if you just, it's a catch-all, and lease financing receivables. So all of this is the non-bank lending that goes into the moniker shadow banking, right? Which includes private equity and private credit, right? So what you're seeing, like this trend inside private equity, right, and private credit, we've talked about this too on other episodes of Weekly Roundup, I believe, but you've seen a very strong push from the private markets or the alternatives industry to push for exchange effectiveness, if you will, or launch of ETF products that would allow for private markets, asset classes, PE, private credit, et cetera, to be marketed towards retail. What that's telling you is you've got a liquidity problem inside of the alternatives, sector of the U.S. financial industry, which, if you read the headlines, right, you see situations like the Bill Ackman video at University of Austin, a few weeks ago, where he talks about the Harvard endowment being extremely over-allocated towards illiquid investments like private equity, real estate, etc. that is where you would see a potential, slowdown in the consumer or in the, financial economy, et cetera, um, really causing trouble. So right now, what you're seeing is very clear in the data. The regulated banking system, Fedwire banks, are, spending 60% of their budget roughly in terms of credit expansion to the private sector. It's going to that shadow banking industry. So that's another situation to continue to watch very closely. What it really speaks of in the end is we're in an era, a decade of tight capacity for dollars on balance sheet, which is really another way of saying interest rates need to be high, right? Secularly rising interest rates. So those are like the core trends I see to watch on the asset side that look particularly interesting. And this kind of just rhymes with the thesis of we're in a state of transition, right? 1980s to 2020, right? You start with leverage buyouts, venture capital, private equity really taking off in the 80s, and that just turbocharged all the way through the ZERP environment of the 2010s. Now we're on the other side of that mountain, and all of this kind of buildup we've seen in alternatives for 40 years is now going to have to navigate this new era we find ourselves in.